So I thought about coming in here for this keynote and really talking about nothing but something that's really kind of at the forefront of our industry right now. And that's burnout, right? I thought about just spending my entire time talking about how cooked we are as an industry. I mean, look at the last few years, what we've been handed. I don't need to remind you, you've lived it, but really beginning with right, December 22nd, 2017, when Congress passed the Tax Cuts and Jobs Act, the most comprehensive overhaul of the Internal Revenue Code in 31 years, we haven't stopped, right? We spent a year just trying to make sense of how's 199A going to work, right? What does this 163J limitation look like? And then as we finally started to kind of get some guidance and make some sense of what we've been handed in that package, well, then what? Well, then COVID hit. And COVID, from a tax perspective, has created effectively what has been a 2-year tax season, right? We had the CARES Act in March of 2020 that we all had to unpack. And then that bled into a delayed tax season that effectively ran until the middle of July. And then we had to turn around in September and October and do the extensions. And then the Consolidated Appropriations Act comes out as we're trying to celebrate, the week of Christmas and New Year's at the end of 2021. And at the end of 2020. And, we don't even get a break then. And we go into another tax season. And then we get the American Rescue Plan. And this tax season gets extended. And we are all hanging by a thread. I mean, just what's been heaped upon us as an industry, so much of COVID relief has funneled through the tax law that, we've really been the ones asked to deliver on behalf of all of our clients this much needed relief, and it's taken a toll. And so I thought long and hard about coming in and just talking for 45 minutes about what we need to do as an industry to prevent mass burnout, to prevent a mass exodus from our younger practitioners. But instead, I pivoted at the last moment and said, what's a good idea? Instead of telling these people who've been working, from dawn till midnight for the last 3 years, that they need to take some time off and find some work-life balance, it's a good idea for me to go into this keynote and basically ask everybody for the next few months to do even more work. So here I am. That's what I'm going to say, but bear with me. It'll make some sense. Okay. And listen, no, I'm in all seriousness, the burnout is a very serious thing, and it's affecting our industry from the youngest people to the most seasoned. But I just want to make sure we understand, well, I would say what unique times we're entering, but maybe they're not so unique anymore. And I'll explain my point with a story. Okay. So I've got 2 kids, a 12-year-old boy, 9-year-old girl. My 9-year-old girl is liable to burst in here any moment as she's getting ready for school and ask me where, a hair tie is. So you may meet Emily in a second. But about 2 years ago, my boy had a birthday party, and it was at a bowling alley nearby. But it wasn't one of those parties, parents love, where you drop the kid off and you go do your own thing for a couple hours and you come back and pick him up. This was one where they wanted us to stick around. And I don't like those kind of parties, and a lot of parents don't, because, well, like a lot of accountants in particular, I am definitely a bit of an introvert. I just am, right? I'm not comfortable in social settings where I don't know a lot of the people. Much prefer to drop the kid off, go ride my mountain bike for a couple hours, swing back and pick him up. But that wasn't the reality on this day. And so, I go in there and I'm making the best of the situation. And inevitably, we ended up in kind of one of those really awkward, uncomfortable circles the parents end up standing in when they don't know what else to do. And we just kind of had that conversation that things trend to when you don't have anything else to talk about, which is basically going around that circle and saying, well, what do you do for a living, right? And so it's going around, and it eventually comes to me. And I say, well, I'm a tax partner at a big accounting firm, and I write and teach about tax policy all around the country. And, if this had been a movie, you would have heard the record screech to a halt, right? I mean, all the air was sucked out of the room when I said what I did for a living. There's never any follow-up questions about what a day in your life is like when you make your living in the tax law. And you could tell that the circle couldn't move on fast enough to the next person. And they get to the next guy and they say, well, what do you do for a living? And I'm not kidding. I am not kidding. This really happened. And, I live about 10 minutes outside of Aspen, Colorado. So sometimes you run into situations like this, but they go to the next guy and say, what do you do for a living? He says, oh, I'm a magician, right? I spend my life, traveling back and forth from Las Vegas to Atlantic City, putting on huge magic shows. So, you can imagine where the conversation went right away. Everybody was just, oh my, you're a magician, show me a trick, or what's it like, or this and that. And I was immediately, right, and forever forgotten, which fortunately was just fine by me because, again, I am an introvert. But the point of that whole story, right, is take that same birthday party and make it happen today, right? Let's just drop us all right back into that bowling alley today. And the truth is, when the circle gets to me and I say, I'm a tax partner who makes my living, in the world of tax policy, and then it moves on to the magician, I'm sorry, but all the follow-up questions are going to be for me and not the magician, because we are entering a period of time here over the next few months where tax law, what we do for a living, right, tax policy is going to rise, maybe already has, to the forefront of the public consciousness, right? Everybody will be talking about what we do. Why? Because as we're going to discuss here today, right? I mean, Congress is looking to do it all over again, right? They are looking to once again overhaul the tax law. Only this time, the intention is to go the opposite direction of the Tax Cuts and Jobs Act, right? The Tax Cuts and Jobs Act, what was a $1.2 trillion tax cut over 10 years. And yes, people certainly get excited about tax cuts. And listen, any tax policy, like any political discussion at all, right, divides the country in half. But now we're talking about tax increases, right? And potentially historically significant tax increases, up to $3.5 trillion over the next 10 years. And when those types of tax increases are being pitched, right, everybody wants to understand, well, what is being proposed? What does it mean for me, right? What should I be thinking about today? What is the likelihood that any of this is going to come to fruition? And so as much as I hate to do this, like I said, I wanted to come in here and say to you, we're burned out. We need to all go on a 3-month vacation, right? Come back in January and start tax season. The reality is we all probably need to shift gears and do something over the next few months that a lot of us maybe aren't that comfortable with, or just don't enjoy. And that is keep our fingers on the pulse of tax reform. And I say that we're not comfortable with it because throughout my career, right, I've probably spent more words in both written and spoken form talking about tax policy than most in our industry. And I'm often met with people who say, why should I care? I got enough going on. Why should I care about something that's not law yet? Why don't you wake me up when it gets signed into law and I'll deal with it then? And look, I get it. With everything we have on our plates, I get it. But what I said before, always think back to that birthday party, right? This moment for us isn't going to last forever, where, as I said, our industry is at the forefront of the public consciousness, right? The idea that everybody is talking about what we do, and it's not going to last. The time is going to come fairly soon, and we'll probably all welcome it at this point, where we'll all return to being the social lepers that we set out to be. But for the time being, right, we are doing ourselves a disservice, our clients a disservice, if we can't speak intelligently about what's happening on Capitol Hill. And what I mean by that is, the tax-paying public, for the next few months, they're not going to have to go, to the inner workings of the Wall Street Journal to find an article about tax reform. It's going to be in the front page, right? They're not going to have to go to the money section of CNN, of USA Today, sorry. It's going to be on the front page, right? It's going to lead news stories across America. And so when people know what you do or find out what you do, they're certainly going to ask you, well, what are your thoughts, right? What's the likelihood this happens? What's actually being proposed? And if you're one who says, I don't deal with any of that stuff until it becomes a reality, well, you're probably missing opportunities. You're missing opportunities to strengthen relationships that you have with existing clients, and you're certainly losing opportunities to bring in new clients, right? To show them that, hey, I'm not just some reactionary accountant, right? I am ready to roll at a moment's notice. I'm thinking now about how, people's situation may change if this law comes to fruition. And if it does get passed, I will be ready to hit the ground running faster than my competitors because I'm staying on top of this. And so again, I know it's uncomfortable. It's even more uncomfortable to talk about with clients because we are so divided as a country. Trust me, no one knows this better than me. I've spent the last 10 years covering tax policy for Forbes. And the only reason I know I do a fairly decent job of remaining down the middle is pretty much in equal numbers. Republicans and Democrats in the comment section both call me an idiot. And in this country, that's the best you can hope for, right? As long as everybody's angry with you when it comes to politics, because there's never going to be a situation where everyone's happy with you. So as long as everybody's angry with you, then you know that you're at least playing it straight, which is ultimately what we should be doing, right? Just telling our clients what the possibility is and what the landscape is. And I know it's delicate. I really do. There's times where all I do is give information like I'm about to give you here about the current landscape, from a political perspective, who controls the House, who controls the Senate, and people get angry. They'll say, that I'm sitting here as a propaganda arm for the Democrats. And it's like, well, no, but the reality is they control the White House, House, and Senate. I kind of need to talk about that if you want to understand what the potential is for tax reform. So I understand how difficult it can be, but trust me, right? I know it's hard to invest time learning law that may never, ever, ever see the light of day. But we are entering this period, as I said, where everyone else is going to have an opinion on what we do. We should probably have an opinion, have an understanding as well as far as what is possible. And so, again, this is just me imploring you at the worst imaginable time, right, to step outside your comfort level perhaps, and just make sure you stay up to date on what's unfolding with tax reform, because it is going to be a fascinating few months. Now, I'm going to share my slides here in a couple moments, because what I want to do is now, just talk a little bit about what is likely to happen over the next few months. And my feelings, right, which nobody cares about, but like my gut on whether or not it will happen changes every day. But let's first talk about just the basic landscape, which I know for a lot of you will probably be certainly rudimentary and redundant, but I want to make sure we're all on the same ground floor, and then talk some more specifics. What types of changes might we see? What are we hearing from Capitol Hill as far as what's realistic compared to what's being proposed? Are there things that we should be thinking about right now, potentially to plan? And, we can kind of wrap it up by just saying, okay, now that we know all of that, what's the likelihood that it actually happens? And of course, everything I'm saying is just my best guess as of August 26, 2021. So don't hold it against me when I am inevitably wrong. But I just thought it'd be a fun conversation to have, because again, this is what everyone else is talking about, particularly this week, right? Some big things happened this week. So I'm going to share my deck with you here for a second. But we just said that, hey, 2017, we went through all of this. We just overhauled the tax law, Tax Cuts and Jobs Act. So how is it possible that we're right back here doing it all over again? And the answer to that is kind of funny, because I was sort of kind of predicting this back when the Tax Cuts and Jobs Act got passed. And what I mean by that is when President Trump won the White House in 2016, the stars were suddenly aligned for the Republican Party because they had a Republican in the White House, they had a Republican in the House, Republican control of the House, and they had Republican control of the Senate, fairly sizable control, a 4-seat margin in the Senate. And so they had 54 seats compared to 46 to the Democrats. And when I say the stars were aligned for the Republicans, now, if you hearken back to your, episodes as a child of Schoolhouse Rock, where you learned how this country works, right? You remember that normally for a bill to become law, it's going to need 60 votes in the Senate. So you say, well, wait a minute, Republicans only own 54 seats and they need 60 votes to make anything happen. They're going to need some help from the Democrats. But in a term that you're going to hear a lot about over the coming months, if you're not already familiar with it, we do have a streamlined process that is able to avoid filibuster called budget reconciliation that allows certain types of bills, including a tax cut or tax increase bill, to be passed with not a 60 vote majority in the Senate, but a simple majority. So 51 votes gets the job done, right? So all of a sudden, Republicans own the White House, House, and Senate. They can pass their vision of tax reform without a single vote from a Democrat. And so once those stars were aligned, Republicans set about, installing their agenda. But in a moment that I think may become a bit prescient for what we're going to see here in the coming months, it's not always a slam dunk. Just because a party controls the White House, House, and Senate doesn't mean they're unified in pushing forward their agenda. And to drive home that point, try to remember, before the Republicans turned their attention to changing the tax law, what did they do first under the reconciliation rules? They tried to repeal Obamacare. And it didn't work. They had enough defections on the Senate side from the Republicans, with the most famous being John McCain, that they couldn't pass it using reconciliation, right? It failed. And so again, we'll come back to that concept later. And as a result, right, they then moved their attention to tax reform. They drafted up the Tax Cuts and Jobs Act, and they passed that $1.5 trillion tax cut using budget reconciliation. So not a single Democrat helped write the bill, not a single Democrat voted for the bill. And so as soon as it passed, when I was teaching the Tax Cuts and Jobs Act to people around the country, I would have to remind everybody that, hey, right, the corporate side of this law is permanent. Most of the individual side expires at the end of 2025, which, by the way, was done to comply with an aspect of reconciliation called the Byrd Rule, which says you can't add to the deficit beyond a 10-year window. But what I told people is this legislation is far more temporary than 2025 because it was passed, right, on a partisan basis, right? Only Republicans. What does that mean? That means that if Democrats, right, and this is what I was saying back in 2020, 2019, 2020, I was saying if Democrats take back the House, which they did in 2018, take back the Senate in 2020, and take back the White House, then I'm going to be right back here in front of everybody teaching the Budget Reconciliation Act of 2021, right? Because obviously if Democrats get their hands on the control, they're not going to let the Republican tax law remain the law of the land, right? No, they're going to want to put their own mark on the tax law and basically instill their own agenda. And so those three things, of course, did come to fruition, right? We had the Democrats take back the House in 2018 and win the White House, obviously. And then the Senate is even more dramatic because we can't necessarily say they took back control of the Senate because it's a 50-50 split. But they do control the Senate because in the event of a 50-50 split, who casts the tie-breaking vote in the Senate, right? Vice President Kamala Harris. She's obviously going to vote Democrat. So that means that, yes, the shoe is on the other foot now. Democrats control the White House, House, and Senate. They can push through their vision of tax reform however they see fit, right? Without a single vote from a Republican. But as we're going to drive home here today, just like we saw with the Republicans trying to repeal Obamacare, it is not necessarily a slam dunk. Now, one more interesting bit of background before we get into the specifics. The Tax Cuts and Jobs Act, as I said, a $1.5 trillion tax cut, whatever your thoughts on it may be, right? And again, I'm not here to provide opinions. I'm only loyal to the math. There are two facts about the Tax Cuts and Jobs Act that will never cease to amaze me. Two statistics, I should say, not necessarily facts. Number one is 9 out of 10 people making more than $40,000 a year got a tax cut from the Tax Cuts and Jobs Act. They paid less in 2018 than they did in 2017. 9 out of 10 people, 90%, right, based on my calculator. Yet, the highest the Tax Cuts and Jobs Act has ever polled with voters in terms of popularity or approval, if you will, right? The highest, 38%. How is that possible? How can 9 out of 10 people get a tax cut, but only, 4 out of 10 be happy about it? And the answer may be the most true thing I'll ever tell you. It is because the only thing people hate more than not getting a tax cut is getting a tax cut only to believe in their heart of hearts that their richer neighbor got a bigger tax cut. And that has been the problem that has plagued the Tax Cuts and Jobs Act since the day it was passed. Again, the numbers don't lie. 9 out of 10 people did get a cut, but the majority, overwhelming majority of the cuts in that bill went to corporations and the wealthiest 1%. And when you think about the way the bill is designed, of course, those were going to be the results, right? I mean, you had the corporate rate dropping from 35% to 21%. That's 1.3 trillion right there of the $1.5 trillion cut. So it's almost like everything else kind of comes out in the wash. I mean, the corporate cut was huge. But then even from an individual perspective, when you create something like 199 Cap A and you reduce the rate on very wealthy landlords' rental income overnight from 39.6% to 29.6%, that is a windfall. That is huge. And so look, right or wrong, right? People did come out of the Tax Cuts and Jobs Act by and large, believing that it was a giveaway to the rich. And the reason I'm telling you that is not because I believe it or don't believe it or any of it. It's because what it did is it framed public perception, which in turn made it very easy for the Democratic candidates for the 2020 presidential nomination to come up with their own tax plans that they think would appeal, right, to the public. This doesn't take a genius. It doesn't require the master touch of a political strategist. If people don't like the Tax Cuts and Jobs Act because they think it gave too much cuts to the corporations and the richest 2%, then what do? You say, I'm going to pay for social programs by taxing the hell out of corporations and the richest 2%. And so that's what all the Democratic candidates for president were unified in doing, whether it was Elizabeth Warren or Cory Booker or Bernie Sanders or Joe Biden. They all built the tax plan around the concept of, right, high earning individuals and corporations paying their fair share, whatever that may be. So I just wanted you to understand how we got to this point where we are looking down the barrel of a potential $3.5 trillion tax increase. And what we do need to understand is if you believe that to be very, very high, and historically it is high, this is a drop in the bucket compared to what had been pitched and proposed even by this president, right? But Bernie Sanders, he was looking at a $16 trillion tax increase. Elizabeth Warren's would not have been all that far behind. But even President Biden originally was looking for something more, in the $5.5 to $6 trillion range to pay for everything. But here's where we stand, right? Originally, President Biden had set out his what's called Build Back Better agenda, and it had a couple different aspects to it. One of them was going to be to go ahead and really invest in the country's infrastructure, its bridges, its roads, you name it. And it was going to pay for that bill by raising taxes on corporations and changing the international tax regime, okay? Then there was going to be a second bill, most likely, that was going to have the rest of the president's agenda, what he calls human infrastructure. So addressing climate change, providing free community college and free pre-K care, right? That sort of stuff. And that bill was going to be paid for by a series of tax increases on high earning individuals. But what happened is the president, with some prodding from the more moderate members of his party, said, let me first set out to show the American people that Republicans and Democrats can work together. Because we don't really need the Republicans, right? As I said, the stars are aligned for the Democratic Party. We can just go ahead and do our thing. But let's go ahead and just show people that we can, in fact, work together. Let's see if we can strike a bipartisan deal on infrastructure. And so about a dozen Republican and Democrats in the Senate got together and started hammering out a deal. And they have come to a deal. It is a $1.2 trillion deal, significantly smaller than about the 2.5 that he was originally looking for in infrastructure, contains only about $600 billion of new spending. But from our perspective, what we're probably most interested in is nary a tax increase to be found. So infrastructure was going to be paid for with great changes to the corporate rate, which we'll talk about, and international regime. None of that is in here because, of course, the Republicans wouldn't agree to that. So really, the only change is that this employee retention credit that has taken over our lives for the last year, it's set to expire December 31st. This bill, if it becomes law, would actually cause the ERC to expire on September 30th instead of December 31st. And so we have this bill that has been agreed to by leaders in the Democratic Republican Party and passed the Senate, has passed the Senate. So you would think, okay, it's a done deal. It's not a done deal. This deal could easily never, ever see the light of day. Why? Because now the Democrats are saying, great, we got your infrastructure thing done. You showed that we can work together. None of those tax increases we need are in there. None of the human infrastructure investment is in there. So now we need to move forward with our agenda. And we know the Republicans are not going to buy into our agenda because they support infrastructure, not this concept of human infrastructure, right? And so we're on our own here. So we've got to come up with a reconciliation bill. But there's zero margin for error, right? Because this human infrastructure bill that's going to be paid for with all these tax increases that they'd like to impose upon corporations and high earners, right? It's got to be met with universal support from the Democrats in the Senate because they only own 50 seats. If even one walks away from the deal, it falls apart. And my gosh, does that set the stage for a contentious few months coming up, because effectively you have 50 senators that all have veto control over any pending legislation, right? And so some of the more progressive members of the Democratic Party in the House have said, look, we do not want to even bring this infrastructure bill to a vote until we have a reconciliation bill that incorporates all of our agenda, pays for it with tax increases, and we know every senator is going to support it on the Democratic side so that it will become law. Once you can guarantee that, then we'll pass that infrastructure bill. And so all the attention now turns to this budget reconciliation bill. And yes, this reconciliation bill is going to be paid for with tax increases that will impact all of our clients. So we have to watch this unfold. We have to see how the negotiations take place, right? I mean, as we're going to see here, there are some very, very significant changes that could come home to roost. But the thing is, right, it's a process. And the first step in the process is simply passing a budget resolution that says, here's how high we can go with all of this. And that really that process didn't get finalized until this week. The Senate had passed its budget resolution saying 3.5 trillion. That's how much we're willing to do. 3.5 trillion in tax increases over the next 10 years. And then they went on recess. The House came back early, and there was some tense situations earlier this week because Moderate members of the House on the Democratic side said, let's just vote this infrastructure bill in, and then we'll deal with budget resolution. And the more progressive members said, no, 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 not a chance. As we've said, this infrastructure bill is going to sit on the sideline until we get unified as a party on budget reconciliation. And so they eventually came to an agreement where they moved forward with budget resolution, passed it this week, and said, we will vote as the House, as a chamber, on the infrastructure bill by September 27th. So what that means from our perspective is, right, I don't know how likely this is, but the Democrats would certainly like to have in the House a piece of tax legislation ready to roll by the end of September. And again, I don't see how those dates align. If they're truly going to vote on the infrastructure bill by the 27th, my guess is they're going to end up having to potentially pass the infrastructure bill, if that's how they feel about it, before they come to an agreement on a budget reconciliation bill, because I just don't see how that legislation could get pulled through in such a short period of time. But then again, if you go back to November of 2017, the span of time between the first piece of legislation being released by the House and that legislation passing the House was 6 days. 6 days. So things can move quickly, but back then they had a little advantage. They had a head start. They had legislation that had been previously kind of drafted up by Dave Camp and others. I don't know that they have that same advantage this year, even though, as we'll see, Ron Wyden has been working on this like crazy. And so it's going to be fascinating to watch it unfold, because now all of the tax writing committees, now that the two budget resolutions have been passed with instructions on what a bill could look like, have to go about, actually writing a bill. And so what types of tax increases are we going to see? Well, the president has made a promise throughout the campaign trail, continuing to today, that there will be no tax increases on anyone earning less than $400,000. Now, a couple of months ago, the administration clarified that that's $400,000 per family, not individual. So if you have two individuals that are married making $300,000 each, taxes are going up on that household, even though no one individual makes more than $400,000. So what are we likely to see being in the bill? Well, let's just run through some of them, just so you know kind of what to keep an eye on. We'll keep it quick. I know my time is coming to an end here in about 10 minutes. But the top rate on ordinary income, it's always the headliner. People always want to know, what's the top tax bracket going to be? And under current law, it's 37%. It was 39.6 after before the Tax Cuts and Jobs Act, dropped it down to 37. And let me tell you, right? Bernie Sanders was looking at a top rate on ordinary income, granted at a very high level of income, of over 70%. Elizabeth Warren was looking in the mid 50s. President Biden, he said, I'm just going to drop it right back to 39.6%. I'm going to put it right back where it was. So this is a very small change. Now, one sneaky thing that was in, his proposal was he would drop the level of income at which that top rate would kick in. And so under current law, right, 37% rate doesn't kick in until you're making about 523 single, 628 married. Under the president's proposal, the 39.6% would kick in at 452 single, 481 married. So that's going to sneak up and catch some people for sure. But this is not a huge change going from 37 to 39.6. Why not? If President Biden is intent on raising taxes on the highest earning taxpayers, why only go from 37 to 39.6? And the answer is probably because he's got some savvy advisors. And they've explained to him that in large part, raising the top rate on ordinary income is more of a symbolic gesture. It doesn't actually generate a whole lot of revenue because, right, most of the high earning people in this country are not doing it on a W-2, right? They're doing it through equity stakes and selling businesses. And so you raise that top rate enough, all you do is get people angry, and you maybe don't really collect a lot of revenue. And so what his advisors, I'm sure, realize is if you want to collect revenue, one of the things we have to do, and this is certainly probably the most watched and controversial aspect of his bill, is you got to get rid of the preferential rate on capital gains and dividends, right? Under current law, you hold a capital asset longer than a year, you get qualified dividends. The highest rate you're going to pay is 20%. Tack on the 3.8% net investment income tax, it could go as high as 23.8. But, that's it. That's all. It's not 39.6. Well, President Biden would like to eliminate that preference for anyone whose taxable income is over $1 million. And so if you're getting rid of that preference, it obviously means your top rate on capital gains and qualified dividends jumps all the way up to 39.6%, plus another 3.8. So you're looking at 43.4% potentially. So this is what everyone's talking about. This is what everyone's going to bother you about as this process unfolds is, hey, I'm looking to sell some stock. I'm looking to sell a business. What is my rate going to be? Do I need to get this thing done by the end of the year so that I only pay a 23.8% rate instead of a 43.4% rate? I mean, this is where all the panic and anxiety is going to be. Now, I want to tell you three things about this change, okay? Number one, look, I don't know anything, but the rumblings out of Capitol Hill are that we will not get a rate anywhere near 39.6. In all likelihood, the highest that some of the more moderate Democratic senators like a Joe Manchin from West Virginia would support would be around 28%. So we'll see if it comes to fruition, but that is certainly what we're hearing. The second thing to remember is it is kind of a quasi-progressive system. So even though the rate would jump to 28% potentially, it's only on incremental income over $1 million. So you'd still get the benefit of 15% rates on some of your gain, 20% on the remaining gain, and that top rate would only kick in on income above a certain threshold. And so, for example, if the only thing a taxpayer had in a given year was $1.5 million of income that was all long-term capital gain, they're not going to pay the full, for example, in Biden's proposal, 39.6% on all of the gain. The first 440 or so would be taxed at 15% under current law. The next 560, taking you up to $1 million, would be taxed at that 20% rate. And then it would only be that $500,000 above the $1 million threshold that would be taxed at the higher rate. I don't know how much better that's going to make anybody feel, but just wanted you to know that. And then the final thing to consider is, of course, everyone's going to want to know, well, how, should I be in a rush to sell? Do I have to sell everything by the end of the year? Well, President Biden, his proposal specifically wants to avoid that outcome. And so I don't know if this will come to fruition or if some of the Democratic senators will balk at it, but President Biden wants to make it so that there's nothing we can do about this, because he wants the change in the rates to be effective as of April 28th, 2021, a date which, according to my rudimentary understanding of the Gregorian calendar, is in the rearview mirror, right? It's gone. And so there's nothing we can do about it. And so if this were to happen, then there's nothing we can do for our clients, right? I mean, if they sell after April 28th, it's done and dusted. It's going to be subject to the new rates. Now, we'll see if that actually ends up happening, but that is what they are, the president is proposing. I mean, one of the biggest changes, I can't imagine will happen, is that we have this concept in our tax law that goes all the way back to a Supreme Court case called, Eisner v. McComber, is that, income has to be realized before you pay tax on it, right? Like there has to be a realization event. You have to get something in return for your asset, basically. And we see that when we make gifts to people or when we die, and there's no tax to the donor or the deceased, even though the assets may be appreciated, because you're not getting any value in return. But the president is adamant, as are other high-ranking Democrats, that has to change. And so what they would look to do is make a gift, make death a taxable event, right? A taxable event. I mean, think about how significant that may be. And so there's a lot more that goes into this than we need to talk about today. But think about what that would mean for our planning, for interlife gifting and upon death. I mean, this has a chance to be very, very significant, but also has a chance to be extremely heated, right? Even among the Democrats, because you're going to hear, if there's one term you're going to hear over the next coming months, it's small businesses and family farms, right? That's what we're going to hear about. Is we can't have this second tax upon death because it's going to decimate small businesses and family farms if we have this loss of tax-free step-up in basis that usually happens upon death under Section 1014. We'll see where it all comes out, but I put some slides here together. I'm happy to send around to the group, where this is what is on the table. It is a fundamental shift in the way we tax death and gifts in our tax code, and fundamental shifts don't happen easy. That's the only promise I can make you. They're also looking to equalize the playing field from a self-employment tax perspective. We know right now, through some quirks in the law, like Revenue Ruling 59-221, that a shareholder in an S corporation, if they materially participate, can both avoid self-employment tax and the net investment income tax. And they're going to look to kind of, do away with that, because you can't pull that off if you're a sole proprietor. You can't pull that off if you're a partner in a partnership. And so they're going to make sure that everybody either pays payroll taxes or net investment income tax. So that would be interesting as well. Even like-kind exchanges are on the table, right? The Tax Cuts and Jobs Act eliminated 1031s for personal property. They still exist for real property. And for reasons I can't really make sense of, President Biden wants to cap the benefit of tax deferral related to a like-kind exchange to $500,000 a year if you're single, $1 million a year if you're married. So this is certainly something people are keeping an eye on. Now, I've heard rumors that this will be left on the cutting room floor and not be in any type of final bill. But we'll see what ends up coming of it. Carried interest, it's the ultimate political football. The idea that hedge fund managers pay capital gains rates, everybody gets angry. It all goes back to Mitt Romney running for president and realizing he paid about a 13% effective rate on millions and millions of dollars of income. And everyone wants to close it down. And Donald Trump even, made some steps to close it down. The reality is, you can close it down. It doesn't generate a ton of revenue. It's more of a symbolic gesture, right? Why should a hedge fund manager who's ultimately providing services pay tax at a 20% lower rate than a working stiff getting a W-2? And so President Biden has some provisions in place to fully eliminate the benefit of carried interest. Senator Ron Wyden has his own bill that would do the same. So there's certainly going to be something in there about carried interest. And then, of course, the corporate changes, right? Joe Biden has said he would like to go to a corporate rate of 28%. But this is what I mean about every single senator on the Democratic side having veto power. We've already heard Joe Manchin from West Virginia say, I'm not going to 28. I could be okay at 25. All it takes is one. If he's voting no, if a bill has 28% in on the corporate side, it's not going to happen. And so you can see how difficult this task is going to be to craft legislation when you got to go around to all 50 senators on every item and say, you good with this? And so even though President Biden would like to go to 28, I can't imagine there's any way he's getting above 25. He also wants to create a new minimum tax, which I don't get this one at all, just because we have a very elaborate internal revenue code, but we want to now tax certain corporations with more than $2 billion of financial statement income on their financial statement income at a 15% rate. And I know why they're doing it, right? Because people get angry when they hear that XYZ company made $4 billion in financial statement income and paid no tax last year. But I'm just from the school of thought that we have the code and regs for a reason. We want to tax corporations. We should probably do it through those code and regs. Okay. And then strangely, President Biden didn't say anything about tweaking 199 Cap A, which again, just didn't make sense. It didn't mesh with his overall overarching kind of theme of increasing taxes on high earners. But Ron Wyden has come out and said, yeah, 199 Cap A is going to change. Under current law, there is nothing that phases you out of the deduction if you make millions and millions and millions of dollars, as long as you have enough W-2 wages or property basis to support the deduction. Well, that would all change. Right, Ron Wyden would basically draw a line in the sand of $400,000 at all filing statuses and say, once you get above that, you will start to lose the benefit of the deduction. The nice thing is for accountants, we're barred from the deduction when income gets above what is currently, about $175,000 if you are single. Well, now an accountant can make all the way up to $400,000 under this proposal and still get the 199A deduction. So it's good news for some, it's bad news for a lot of others. So this is where we stand. I mean, now is when all the magic happens. Now is when Congress has to draft the bills, and we have no idea what we're going to see, right? And Ron Wyden has been waiting for this moment for a long time as the chair of the Senate Finance Committee. He's certainly going to, get the ball rolling. He's already released proposals on, rent credits and the like, as well as overhauling the international regime. But they're all going to piece together these different provisions. They're going to take the temperature of the Democratic senators and then move forward. And so what happens is they'll pass a bill in the House, which will probably pass, without much trouble. And then it's going to go to the Senate. And that's where all the drama is going to unfold. Because again, any one of the senators doesn't like something in there, the whole thing falls apart. And we've got two senators that everybody's watching, right? Kirsten Sinema and Joe Manchin from West Virginia. So Sinema from Arizona, Manchin from West Virginia. They've already said 3.5 trillion, which everyone's agreed to. That's too high. I'm not voting for a bill that has 3.5 trillion in spending. So, okay, well, how high is not too high? That's what they're going to have to ask. And you're going to really reach a point where if Sinema and Manchin are driving down the price, the rest of the party is going to say, who are you to hijack the entire party and what our goals are here? And you're going to see unbelievable amounts of infighting because Democrats recognize certainly that this is their only chance. They've got control of the White House, House, and Senate. We've got midterms coming up in 2022 where history shows us they're going to lose some of this control. And so they know they've got this shot. And if the party is held hostage by one or two senators that balk at some of these changes, it's going to get very heated very, very fast. And I know it's not fun, right? I know it's not fun to follow this stuff when it changes every day, when I guarantee you, every proposal we just talked about, it's going to change 100 times before it eventually becomes law, if it becomes law. But let's go back to what we said, right? This moment doesn't last forever. Eventually, people won't care about what we do again. People won't be talking about the tax law in elevators and in dinner parties and wherever else. But while they are, we should be able to talk about it too, right? Like I said, it's if a client calls up and says, what's going to happen with this capital gains rate? And you say, I don't pay attention to that stuff that happens. The likelihood is that client's going to turn around and go, wait a minute, everybody I talk to at the gym, on the golf course, right? At my kids' soccer games, everybody's talking about this tax law, but the one person I'm paying to understand the tax law tells me they don't care about proposals. So, this is not the time for it. We're all tired. We're all unbelievably busy, but we are at a historically significant time. And we are looking at potentially a second major overhaul of the tax law in 4 short years. We can't ignore that, right? So I know it's tough, but let's stick it out a couple more months. Let's read, let's communicate with our clients. That's all we need to do. We don't need to take sides. We don't need to have opinions. Just communicate. Here's what happened on Capitol Hill today. Here's where things stand as of now, just so they go to bed at night knowing that you have your finger on the pulse of tax reform. Okay. So again, the last thing anybody wanted was for me to come here and implore you to do more work, but that's exactly what I just did. And I know it's not the most fun work for everybody, but it can strengthen relationships that you've had for years. It could land you a number of new clients. And again, eventually things will slow down for us. So enjoy the rest of your conference. Thank you so much for having me. Again, I really wish this could have gone a different direction. I could have been there in person. I've got some friends I wanted to see, but it is what it is. Maybe next year, whenever else you get back together, I'll get to see you in person, unless you all, leave today and go, we're not bringing that guy back. He just we're exhausted. And he just told us all we need to go do some more work for the next few months. But thank you so much for having me. I don't know if there's any questions for me or anything. I have nowhere that I need to be. So if you have questions, I'll stick around. If not, move on, turn off the Zoom and enjoy your conference.